The collapse of Lehman Brothers on September 15, 2008, wasn't just the failure of a single investment bank. It was the moment when the modern global financial system revealed itself to be far more fragile and interconnected than anyone, including the regulators and bankers who were supposed to understand it, had realized. And the decision by Treasury Secretary Hank Paulson and Fed Chairman Bernanke to let Lehman fail, to refuse the bailout that everyone expected, triggered a cascade of consequences that within days brought the entire global economy to the brink of complete collapse, froze credit markets that companies depended on for daily operations, caused the failure or near failure of dozens of other institutions, required unprecedented government interventions in the U.S. and abroad, and ultimately changed forever how we think about banking regulation, systemic risk, and the relationship between finance and the real economy. But to understand why this one failure had such outsized impact, why it was different from the collapse of Bear Stearns 6 months earlier or the later controlled failures of other institutions, we need to understand what Lehman was, how deeply embedded it was in the global financial system, how the decision to let it fail was made and why, and how that decision, which seemed defensible in the moment based on moral hazard concerns and political constraints, turned out to be one of the most catastrophic policy errors in modern financial history, creating damage that could have been avoided and setting in motion a crisis that would cost millions of jobs and trillions in lost output. Lehman Brothers was 158 years old when it died. Founded in 1850 by German immigrant brothers who started as cotton traders in Alabama, survived the Civil War, moved into commodities and eventually finance, became a major Wall Street firm, and one of the bulge bracket investment banks, the elite group that included Goldman Sachs, Morgan Stanley, Merrill Lynch, and a few others who dominated global securities trading and investment banking. By 2007, Lehman had 25,000 employees, assets of $680 billion, and generated billions in annual profits. It was particularly aggressive in the mortgage-backed securities business during the housing boom, underwriting and trading the complex instruments that packaged mortgages into securities, and it used enormous leverage. Like all investment banks at the time, leverage ratios of 30-to-1 were common, meaning they had $30 of assets for every dollar of equity. So even a small decline in asset values could wipe out all the equity. And this leverage was hidden in various ways, including the infamous Repo 105 transactions where assets would be temporarily moved off balance sheet at quarter end to make the bank look less leveraged than it really was. But what made Lehman truly dangerous wasn't just its own balance sheet, but its role as a counterparty to thousands of other financial institutions. It was deeply embedded in the web of derivatives, repos, and other contracts that constitute the plumbing of modern finance. So when it failed, it didn't just affect Lehman's shareholders and creditors. It affected everyone who had exposure to Lehman, and everyone who had exposure to institutions that had exposure to Lehman, creating a cascade of uncertainty and fear that nearly destroyed the entire system. The warning signs had been obvious for months. Lehman's stock price had been falling through 2008 as the housing market collapsed and the value of mortgage-backed securities plummeted. The firm reported billions in losses, tried to raise capital and failed, watched as Bear Stearns collapsed in March 2008 and was rescued by JP Morgan with Fed assistance. And everyone on Wall Street understood that Lehman was next. The question wasn't whether Lehman was in trouble, but whether the government would rescue it. And the universal assumption was yes, because Bear had been rescued, because letting a major financial institution fail during a crisis seemed unthinkable, because surely policymakers understood that the interconnections were too complex and the risks too great to allow a disorderly failure. But this assumption was wrong. Paulson and Bernanke had been heavily criticized for rescuing Bear, accused of creating moral hazard by teaching banks they'd always be bailed out, and they had. Political constraints. The Bush administration was ending. There was no appetite in Congress for more bailouts. The public was angry about Wall Street getting rescued while regular people lost their homes. And there was a genuine belief, later revealed to be catastrophically mistaken, that the system could handle Lehman's failure, that 6 months had been enough time for other institutions to reduce their exposure, that Lehman was smaller than Bear in some ways, and its failure would be less systemic. So when Lehman's last-ditch efforts to find a buyer over the weekend of September 13th to 14th failed, when Barclays walked away and Bank of America chose to buy Merrill Lynch instead, Paulson refused to provide government money to facilitate a deal, and Lehman filed for bankruptcy on Monday, September 15th, the largest bankruptcy in history. And the world discovered very quickly just how wrong the assumption about manageable failure had been. The immediate impact was chaos. Lehman had been a major player in commercial paper, the short-term debt that companies used to finance daily operations, payroll, inventory, and when Lehman failed, the commercial paper market froze. Companies suddenly couldn't roll over their debt, couldn't finance operations. General Electric, one of the world's largest and most stable companies, couldn't borrow money. If GE couldn't borrow, nobody could. The money market funds that bought commercial paper panicked, and one fund, the Reserve Primary Fund, broke the buck, meaning its net asset value fell below $1 per share because it held Lehman debt that was now worthless. This triggered a run on money market funds, investors trying to withdraw their money, forcing funds to sell assets to raise cash, and money market funds held trillions and were supposed to be completely safe. They were where companies parked cash overnight, where individuals put their savings, and suddenly they weren't safe. The entire shadow banking system of investment banks, money market funds, commercial paper, repos, all the mechanisms that had grown up outside traditional banking and provided much of the credit that the economy ran on. This system seized up completely. It was like an engine without oil, every moving part grinding to a halt, and the real economy immediately felt the impact. Credit dried up. Companies couldn't make payroll, suppliers couldn't get paid, trade finance disappeared so. International shipments stopped. The global economy was grinding to a halt not because factories couldn't produce or consumers didn't want to buy, but because the financial plumbing had broken and nothing could flow. The contagion spread internationally with terrifying speed. AIG, the giant insurance company that had sold credit default swaps on mortgage-backed securities, essentially insurance against their failure, faced collateral calls it couldn't meet as the value of those securities collapsed. And if AIG failed, every institution that had bought protection from it would face losses. Every bank that had used AIG swaps to hedge their mortgage exposure would suddenly be unhedged. So 2 days after Lehman failed, the Fed rescued AIG with an $85 billion loan that would eventually grow to $182 billion, the largest bailout in history. But even that wasn't enough to stop the panic. Morgan Stanley and Goldman Sachs, the two remaining major investment banks, saw their stock prices collapse as investors bet they'd be next. Both were forced to convert to bank holding companies, accepting Fed regulation in exchange for Fed protection. Merrill Lynch had already been sold to Bank of America in a shotgun merger the same weekend Lehman failed. So within 1 week, the independent investment bank model that had dominated Wall Street for decades was extinct. All of them either failed, merged, or converted to banks. Washington Mutual failed, the largest bank failure in U.S. history. Wachovia nearly failed and was rescued by Wells Fargo. In Europe and Asia, the contagion spread. British banks needed emergency funding. Iceland's entire banking system collapsed. Banks everywhere hoarded cash and refused to lend to each other. The LIBOR-OS spread, a measure of stress in interbank lending markets, spiked to levels that indicated complete breakdown of trust. Banks didn't know which other banks had exposure to Lehman or other failing institutions, so they didn't trust anyone. And when banks won't lend to each other, the entire credit system collapses. The policy response was massive, chaotic, and improvised. The Treasury proposed a $700 billion bailout program, TARP, to buy toxic assets from banks. Congress initially rejected it. The stock market fell 777 points in a day, the largest point drop in history. Congress reconsidered and passed it. But implementation kept changing as the Treasury realized buying toxic assets wasn't the solution. Instead, they used the money to directly inject capital into banks, making the government a shareholder. The Fed cut interest rates to zero, and when that wasn't enough, invented quantitative easing, buying trillions in bonds to inject money into the system. They created numerous emergency lending facilities with names like TLF and TSLF and CPFF, alphabet soup programs designed to provide liquidity to every corner of the financial system. They guaranteed money market funds to stop the run, coordinated with other central banks to provide dollar liquidity globally because the dollar was the reserve currency and foreign banks needed dollars but couldn't get them. Governments around the world implemented similar measures, guaranteeing bank debt, injecting capital, providing liquidity. It was the most aggressive coordinated intervention in financial markets in history. And even with all of this, even with governments doing everything they could think of to stop the collapse, it was a near thing. For weeks in October 2008, the global financial system was on the brink of complete failure. If it had failed, if the interventions hadn't worked, we would have faced an economic collapse that made the Great Depression look manageable. ATMs would have stopped working, companies couldn't have made payroll, supply chains would have broken, food distribution would have been disrupted. This was how close we came to civilizational-level crisis, all triggered by the decision to let Lehman fail. The question that haunted policymakers afterward was whether Lehman could have been saved, whether the decision to let it fail was necessary or was a catastrophic error, and the answer that emerged from subsequent analysis is complex. Paulson and Bernanke claimed they didn't have legal authority to rescue Lehman, that the Fed could only lend against good collateral and Lehman didn't have enough. But this was disputed because they found ways to rescue AIG days later using similar authority. The more honest explanation seems to be that they were worried about moral hazard and political backlash. They wanted to demonstrate that not every institution would be rescued, to impose some market discipline. But they catastrophically underestimated the systemic consequences. They didn't fully understand how interconnected Lehman was, how many counterparties would be affected, how much uncertainty its failure would create. They thought the system had had 6 months since Bear to prepare, that exposures had been reduced, that Lehman's failure would be contained, and all of these assumptions proved wrong. The system hadn't reduced exposures adequately. Institutions didn't know their own exposures, much less others. The complexity of derivatives and repos meant that Lehman's failure created uncertainty throughout the system. And once uncertainty took hold, once nobody knew who was solvent and who wasn't, trust evaporated and the entire system locked up. In retrospect, it's clear that Lehman should have been rescued, that the moral hazard concerns, while valid, were far less important than preventing systemic collapse, that you don't worry about teaching banks lessons in the middle of a crisis. You worry about that in normal times through regulation and supervision, but in a crisis you do whatever it takes to prevent collapse, and the failure to do that with Lehman was a mistake that cost trillions. The changes that Lehman's collapse forced on the global financial system were profound and permanent. First, it destroyed any remaining illusion that markets could self-regulate, that complex financial institutions could be trusted to manage their own risks, that light-touch regulation was sufficient. The ideology of financial deregulation that had dominated from the 1980s through 2007 was discredited. And while the regulatory response, Dodd-Frank in the US and Basel III internationally, was imperfect and in some ways inadequate, it did represent a fundamental shift. Banks now face much higher capital requirements, stress tests to see if they could survive various scenarios, living wills that plan for their orderly dissolution, restrictions on proprietary trading through the Volcker Rule, the creation of the Financial Stability Oversight Council to monitor systemic risk. Were these regulations sufficient? Probably not. Were they fought by the industry and weakened over time? Absolutely. But the principle that banks needed much stronger regulation and supervision, that systemic risk needed to be managed, that moral hazard could be addressed through ex-ante regulation rather than ex-post punishment, this became accepted in a way that wouldn't have been possible without Lehman's collapse, showing how catastrophic regulatory failure could be. Second, Lehman established the too big to fail doctrine explicitly. Before 2008, there was debate about whether the government would rescue major institutions. After Lehman, there was no debate. The failure was so catastrophic that no subsequent administration would allow it. Every other major institution threatened with failure after Lehman was rescued or managed to avoid disorderly collapse. Citigroup was rescued. Bank of America was rescued. The European banks were rescued. The implicit guarantee became explicit. And while this creates moral hazard problems, while it means large institutions can take risks knowing they'll be bailed out, the lesson of Lehman is that the alternative, allowing disorderly failure, is worse. The challenge is addressing the moral hazard through regulation and supervision, making sure institutions don't take advantage of the implicit guarantee to take excessive risks. And that regulation has been strengthened post-crisis, though whether it's strong enough remains debated. But the principle that systemically important institutions cannot be allowed to fail in a disorderly way This is now firmly established, and any future crisis will be managed with that principle in mind, which is both reassuring because it means we're less likely to repeat Lehman's mistake, and concerning because it means the financial system knows it's protected, which affects behavior in ways that create long-term risks. Third, Lehman changed how we think about financial system complexity and interconnection. Before the crisis, there was an assumption that financial innovation and complexity were mostly beneficial, that they spread risk and made the system more resilient, that derivatives and securitization allowed risks to be sliced and diced and distributed to those best able to bear them. Lehman proved this was wrong, or at least that it was only partly right. Yes, complexity could spread risk, but it could also obscure risk, create interconnections that nobody fully understood, amplify shocks rather than dampening them. The failure of one institution could cascade through the system in ways that were impossible to predict or contain, and this realization led to efforts to simplify the system, to require that standardized derivatives be cleared through central counterparties rather than traded bilaterally, to improve transparency about exposures and interconnections, to map the financial system better so regulators could identify where risks were concentrated. These efforts have had mixed success. The financial system remains extraordinarily complex, but at least there's awareness now that complexity itself is a form of risk, that interconnection can be dangerous, that what looks like risk spreading in normal times becomes risk concentration during crisis, and that managing systemic risk requires understanding the topology of the financial network, who owes what to whom, where the critical nodes are, what happens if they fail. Fourth, Lehman established that central banks would do whatever necessary to prevent financial collapse. The tools invented during the crisis, quantitative easing, emergency lending facilities, dollar swap lines with foreign central banks. These became part of the permanent toolkit, not just theoretical options, but proven techniques that worked, and this changed central banking. The Fed's balance sheet before the crisis was less than $1 trillion. After multiple rounds of QE, it peaked at $4.5 trillion. Other central banks followed similar paths, and while there were concerns about whether QE would cause inflation or create distortions, the immediate necessity of preventing collapse overrode these concerns, and the lesson was that central banks have enormous power if they're willing to use it, that they can create as much money as needed, that the constraint on monetary policy isn't technical, it's political and psychological, whether policymakers are willing to act aggressively enough, and whether markets will maintain confidence. And post-Lehman, the answer was yes to both. Central bankers learned they could and should act massively during crisis, and markets learned to expect this, creating the central bank put, the expectation that central banks will support asset prices during crisis, which is both stabilizing because it prevents panic and destabilizing because it encourages risk-taking. But the alternative, Lehman-style collapse, is worse. The human cost of Lehman's failure is harder to quantify, but no less real. The financial crisis that it triggered, or at least massively accelerated, caused the Great Recession. Unemployment in the U.S. peaked at 10%. Over 8 million jobs lost. In Europe, it was worse. Unemployment in Spain and Greece exceeded 25%. Youth unemployment was over 50%. Millions of people lost homes to foreclosure. Retirement savings were devastated. Young people entering the job market faced years of limited opportunities. The crisis created a lost generation. People whose careers were permanently damaged by graduating or starting out during the recession, and the political consequences included the rise of populism, Tea Party and Occupy Wall Street initially, then Trump and Brexit, and various European nationalist movements. The breakdown of consensus politics and the rise of extremism on both left and right. All of this traces back at least partly to the financial crisis and the anger it generated about bailouts for banks while ordinary people suffered, about inequality and elites, and the sense that the system was rigged. Lehman's failure and the crisis it triggered open wounds in society that still haven't healed, that manifested politically in ways that continue to shape our world. And while you can't draw a direct line from one bank failure to Trump or Brexit, you can trace the path. The financial crisis led to the Great Recession, which led to prolonged unemployment and stagnant wages, which fed anger and resentment, which populist movements exploited. So the consequences of letting Lehman fail extended far beyond finance. They reshaped politics and society in ways that continue today. The counterfactual haunts anyone who studies this period. What if Lehman had been rescued? What if Barclays had been allowed to buy it with government assistance? What if the Fed had engineered a JP Morgan-style takeover? Would the crisis have been prevented or merely delayed? And the consensus among economists and historians is that rescuing Lehman would have significantly reduced the severity of the crisis. It might not have prevented recession entirely. The housing bubble was deflating. Banks had losses that would have materialized regardless. But the acute phase of panic, the freezing of credit markets, the near collapse of the system, this was largely Lehman-specific, caused by the uncertainty and cascade effects of its disorderly failure. If Lehman had been rescued, if AIG had been rescued preemptively, if the government had made clear it would support all systemically important institutions, the crisis would still have been serious, but might have looked more like the early 1990s S&L cleanup or even the 2001 recession, painful but manageable. Instead, we got the worst crisis since the Depression, and the difference, the additional suffering and cost, can be attributed in large part to the decision to let Lehman fail. This doesn't mean every institution should be rescued always. It means that in the middle of a panic, preventing systemic collapse takes precedence over teaching lessons about moral hazard, and that the political and ideological constraints that prevent it. Lehman's rescue were wrong. That Paulson and Bernanke were operating under false assumptions about both the legal constraints and the systemic impact, and that this mistake, while understandable given the pressures they faced, was catastrophic. The legacy of Lehman is that one bank's failure almost destroyed civilization as we know it. That's not hyperbole. If the interventions in October 2008 had failed, if governments hadn't thrown everything at the crisis, if central banks hadn't expanded their balance sheets by trillions, if the coordinated global response hadn't worked, we would have faced complete financial collapse. And from financial collapse would have flowed economic collapse, supply chain disruption, potential food and energy shortages, social breakdown. The complex, interdependent global economy that we take for granted depends on the financial plumbing working, on credit flowing, on trust existing, and Lehman's failure broke all of that, showed how fragile it was, revealed that the apparent stability was built on assumptions that proved wrong, that the complexity everyone thought made the system resilient actually made it fragile, that the interconnections everyone thought spread risk actually concentrated it, that the innovations everyone praised as making finance more efficient actually made it more dangerous, and the only reason we survived was massive government intervention, improvised in real time by policymakers who didn't fully understand what they were facing but understood enough to know they had to try everything. And even with all that, even with unlimited resources thrown at the problem, it was close, too close. And the question for the future is whether we've learned enough from Lehman to prevent it from happening again, whether the regulations put in place are sufficient, whether future policymakers will have the courage to act as aggressively as needed, whether the political environment will allow them to, whether the complexity and interconnection that made Lehman so dangerous have been reduced or just reconfigured, and whether next time the crisis emerges somewhere unexpected, in shadow banking or cryptocurrencies or private equity or some corner of finance we're not watching carefully enough. Because the lesson of Lehman isn't that one bank was too important to fail. It's that the system was designed in a way that made failure catastrophic, that we built a global financial architecture that worked fine in good times, but was extraordinarily fragile under stress. And while we've made changes, while regulations are stronger and supervision better and central banks more prepared, the fundamental fragility remains, the complexity remains, the interconnection remains. And so the risk remains that another Lehman moment, another point where one institution's failure cascades through the system, another panic that can't be controlled, will emerge, and whether we'll handle it better next time or whether we'll discover new ways for the system to fail that we haven't anticipated, that's the question that Lehman's collapse left us with. A question we won't know the answer to until the next crisis comes. And that uncertainty, that knowledge, that the system came so close to complete failure and might again, is itself a legacy of September 15, 2008. The day one bank's collapse changed everything about how we understand finance, risk, regulation, and the frightening interdependence of the modern global economy.